So oil prices dropped today after the U.S. indicated it is prepared to implement measures to stabilize shipments through the Strait of Hormuz, possibly by backstopping insurance for vessels or getting U.S. naval ships to escort tankers. We're joined now by Eric Lee, global energy strategist at Citi. Eric, thanks very much. I was amazed today to see that WTI is up something like 30% this year now from a very low base.
Yes, I mean, part of that is that the backdrop to this market before this latest geopolitical uptick was that 2026 was expected to be a year of oversupply, right? So prices, this time last year were around $80 Brent. By the end of the year or early this year, they were in the 60s. So I think that's part of the backdrop for this. This of course, major uptick in geopolitical risk right now.
What is your take? I mean, people are talking about the Arab-Israeli war back in 1973 that saw oil prices soar, but of course the Arab countries implemented an oil embargo at that time. There's no talk of anything like that. But there are fears that this conflict could be drawn out and spread.
Yeah, absolutely. And there's a very difficult range of outcomes to contemplate. I mean, you refer to 1973. That was a cut of production of, I think, about 6% of world crude production at the time. I think somewhere around 3-4 million barrels a day in a 55 million barrel a day market. Here we are confronting multiple scenarios. The big one is what's happening now, and the question is how long it happens for, which is flows through the Strait of Hormuz go close to zero, and that's 20 million barrels a day of crude oil, mostly crude oil, a lot of petroleum products, and as you mentioned, well, other commodities, including LNG as well. And so if that's the biggest supply risk. If it moves back to something that's more internal Iran risk, where it's 2 to 3 million barrels a day of production and exports kind of is in risk for a long time, that's a different scenario and a lower but still elevated level. And of course, if we move back to deal making and flows can renormalize, we could be back at the low 60s. So there's a range of outcomes, and I think that's part of the trickiness of what's going on right now.
Isn't it interesting how, though, we've gone from, as you say, talk of a surplus and gloom hanging over the oil market in terms of higher prices to this huge turnaround?
Yes, and in some ways it's a continuation of the story from last year, right? Recall last June when we had the first, the last time U.S. and Israel bombed Iran's nuclear facilities. And at that point, oil also hit about $80 and then started coming off as there was this de-escalation. So certainly there's that question mark. On the other hand, you can compare to 2022 with Russia-Ukraine, where the fear of loss of 5 million barrels a day of crude or thereabouts led to oil prices moving to 130, 140 at times. So I think the backdrop of a better supplied market is helping to control some of those larger, higher scenarios. But again, the Strait of Hormuz with 20 million barrels a day of flow and only limited bypass pipeline capacity, mainly through Saudi Arabia, is just something that can overwhelm even that sort of bearish backdrop.
And Qatar has billed itself for a long time as a reliable LNG producer. And we just saw North American natural gas not reacting because, of course, we're self-sufficient, really, in this part of the world in natural gas, more than self-sufficient. But Qatar, that's a blow to them, isn't it? And a blow to Asian countries that depend on that LNG.
Absolutely. And to Europe, where, European natural gas prices contribute to the very high energy prices that contributed to a chunk of broad deindustrialization in many ways. And the fact that, global gas prices had eased off the past few years has been a relief to the European economies as well. And now we're back at, TTF, global gas prices now, spiked to 55 euro per megawatt hour, back to 45 now. That's about $15 per MMBTU. So this has massive implications. And that's where, again, it comes back to this tension of, the White House, the US has, of course, various questions about what objectives are in Iran, but also is clearly very sensitive to high oil prices, high gasoline prices in the midterm election year. So there are a lot of reasons that we could, in a number of weeks, move back to de-escalation and deal making. But again, there are very, very many, which is our base case, but there are very many dangerous bull and extremely bull scenarios at the moment.
We've very few seconds left, and sorry about that, but we just showed a chart that indicates that an awful lot of Europe's LNG comes from America, although, of course, it gets pipeline supplies and it has other sources of gas.
Yes, I mean, I think the thing to say there is yes. But given that, if you take out Qatar, and that's, about a fifth of the global energy market, then Asia will need to also, compete for those same sources, and it will knock on Europe, even if Europe is not as big of a traditional buyer of Qatari LNG.
Eric, thank you very much indeed. Eric Lee, Global Energy Strategist at Citi.